When people think of robotics, they think humanoids walking around factories. But today we're going to learn that that's not where the real money is when it comes to robotics. The real robotics boom is happening underwater, inside warehouses, and quietly inside companies you already own. Today I'm breaking down 3 robotics plays with a 3 to 5 year horizon. One small cap that gives autonomous submarines their eyes and power, one mega cap that's secretly running the largest robot army on Earth, and one ETF that profits no matter which robotics company wins. This isn't sci-fi, these are real machines, real contracts, real cash flow, and in some cases, national defense budgets paying the bills. If you've been looking for exposure to robotics without gambling on the hype, then this video might completely change how you think about the industry. First, please help me out a bit and click the thumbs up or subscribe button if you like these types of breakdowns. Let's start with the one almost nobody is paying attention to, but navies around the world already depend on. Kraken Robotics, ticker symbol PNG. For the record, I do own this stock. Kraken Robotics is a Canadian marine tech company that specializes in the eyes, ears, and power for the underwater. In the world of investing, it's considered a robotics play because it provides the brains and the components that allow underwater machines to function without human intervention. They have 3 core products and services. First, they offer high-resolution sonar. Kraken's technology provides ultra-high-resolution 3D imagery of the ocean floor at centimeter scale. This allows robots to see underwater mines, cables, and shipwrecks with photographic clarity in dark, murky waters. Second, they produce subsea batteries. These are designed to operate at depths up to 6,000 meters. Third, Kraken builds its own robotic platforms, such as the Catfish, a towed sonar vehicle, and provides sensor power payloads for major manufacturers like Anduril. If you've been looking for a clever way to get into defense and robotics, this could be the play. Kraken is a primary supplier for Anduril Industries, a high-growth defense tech company. Beyond selling hardware, Kraken uses its own robotics to provide subsea surveying services for offshore wind, oil and gas, and defense clients, creating a recurring revenue model. So the bottom line is Kraken serves leading navies, defense contractors, and offshore energy firms, solving the challenge of seafloor imaging and subsea detection. One thing to note is that once a Navy customer adopts Kraken's system, switching is costly. Customers need to invest in training, integration, and data workflows around Kraken's equipment. Kraken holds several multi-year foundational contracts with national navies such as the Royal Canadian Navy, the Asia Pacific Navy, and the Royal Danish Navy. There's currently a backlog in recent orders, and in December of 2025 alone, Kraken secured approximately $12 million in new orders, adding to the already robust backlog that has been currently being converted into cash flow for 2026. So let's look at the financials and risk. Their current market cap is $2.4 billion, roughly. The price to earnings ratio is expensive at around 130. However, I should note that this is somewhat normal for high growth companies. In fact, as a comparison, let's look at ticker KTOS, which is currently over 900 PE. Kraken has delivered roughly 40 to 60% annual growth. Recently, in the latest quarter, up 60% year over year, and guidance indicates roughly 40% growth for the full year 2025. This reflects strong demand and execution. Over a 3 to 5 year span, Kraken is expected to maintain high growth, where simply Wall Street projects 55% EPS CAGR, albeit a very small base. Kraken's balance sheet is very strong. It holds $38 million in debt, and cash is about $126 million as of Q3 2025. Some key risks to note are that if there are delays or cuts in Navy budgets, this could hurt orders, though currently the trends are positive. Now, being a defense-adjacent company, Kraken is subject to government export controls and procurement rules. Any regulatory shifts like export restrictions on sensitive tech could limit its accessible market. Kraken has clear catalysts. One is the conversion of its record backlog into revenue as it delivers on recent sonar and battery orders and new contracts. Now, over the next 1 to 2 years, we should see milestones such as Kraken's systems being adopted into new naval programs. For example, NATO exercises in 2025 already saw record deployment of Kraken's sonar. Now, Kraken does issue news releases regularly on contract wins and financial results. Check out their website for more details. And here's what I'm doing. Now, this is not financial advice. If Kraken's stock was to drop meaningfully, say on a market pullback or a short-term earnings miss, it might be an opportunity to buy more shares. Like I said, I do own this stock. While it is currently trading a bit expensive, this is normal for high growth companies. And for me, it is a long-term play with a 3 to 5 year horizon. Next, let's talk stock number 2, Amazon, which is the robotics giant hiding in plain sight. This is another stock I own. And as we know, Amazon is the biggest e-commerce company and has a massively profitable cloud computing service. Amazon has deployed over 1 million robots across more than 300 fulfillment centers worldwide. That's 1 million machines moving packages, sorting inventory, and working alongside humans. They've deployed more robots than any other company in the world outside of dedicated robotics manufacturers. And they're not slowing down. In 2024, Amazon opened its most advanced robotic fulfillment center in Louisiana, spanning 5 floors and more than 3 million square feet, making it the most automated warehouse in their history. Here's where it gets interesting. From an investment perspective, Amazon doesn't buy those robots. They build them. Back in 2012, they acquired Kiva Systems for $775 million. That means every efficiency gain flows directly to their bottom line. No licensing fees, no supply chain dependencies, no markup to third-party vendors. The performance numbers are compelling. Their Sequoia system identifies and stores inventory up to 75% faster than previous methods and reduces order processing time by up to 25%. Now that translates directly into same-day and next-day delivery capabilities that competitors struggle to match. They've also launched Deep Fleet, a generative AI model that coordinates robotic movement across their entire network, improving fleet travel time by 10%. Think of it as an intelligent traffic system for a city of robots. Now let's talk about the risks. Robotics investments require massive upfront capital. If consumer spending drops significantly, that fixed cost becomes a liability rather than an asset. There's also execution risk. Integrating robots into a complex warehouse operation isn't straightforward. The bottom line, here's what the numbers actually look like right now. In Q3 2025, Amazon posted $180 billion in revenue, up 13% year over year. Net income hit $21 billion. AWS grew 20%, its fastest pace since 2022, generating roughly $33 billion in quarterly revenue and $11.4 billion in operating income. With a PE around 34, Amazon actually looks reasonable compared to its 5-year average of 50 and its 10-year average of over 100. You're not paying crazy growth multiples here. Wall Street values Amazon as an e-commerce plus cloud. They're not wrong, but they're probably underpricing the robotics infrastructure that's already deployed at scale. No competitor can match this. That's the case for Amazon as a robotics play, hiding in plain sight. The market sees a retail and cloud giant. I see a robotics giant that happens to sell you stuff online. When you buy Amazon stock, you're not just getting e-commerce and AWS. You're getting a vertically integrated robotics operation that's been refining its capabilities for over a decade. Now that's the case for viewing Amazon as a robotics play hiding inside a retail stock. Now before we talk about my final way of investing in robotics, there's a warning that needs to come first. Because if you get this part wrong, robotics investing can absolutely destroy your returns. A lot of investors hear robots and immediately think humanoids like Optimus, machines that walk, talk, fold laundry, work factory jobs, etc. It looks incredible on video. The projections sound massive. Citi is throwing around numbers like $7 trillion over the next 25 years. But here's the reality. Most humanoid robot companies today are marketing stories, not businesses. Elon Musk says Optimus could represent 80% of Tesla's future value, and that's a bold claim. As of late 2025, Tesla temporarily halted mass production of Optimus, citing design challenges. Agility Robotics is probably the furthest along commercially. They raised hundreds of millions of dollars at a multi-billion-dollar valuation, yet production is still in the hundreds of units per year, with robots costing around $250,000 each. Also, they are not publicly traded. Even people inside the industry are calling this out. CEOs and researchers have warned that many of the slick demos you see are remotely operated, heavily edited, or aspirational. The autonomy looks real on screen, but often it isn't, and the technical problems are not small. Battery life, dexterity, reliability, costs, supply chain constraints, they are physics and manufacturing problems. So if you chase pure play humanoid robot stocks right now, You're usually buying billion-dollar valuations on companies with minimal revenue and unproven products. Here's what I think is the smarter play on robotics. And again, this is not financial advice. This is just what I am looking at. If you still believe robotics is a long-term trend, you play picks and shovels. Instead of betting on which company or humanoid company survives, you invest in the components every robot needs, no matter who wins. Sensors, actuators, motors, AI chips, industrial automation systems. Also, check out my latest video on silver. These companies are profitable today. They sell real products to real customers, and they will supply whoever eventually wins the race in robotics. That framework is exactly how I think about this final robotics investment. While I don't own it yet, it is an ETF. Ticker symbol is BOTZ, B-O-T-Z. Now this is a Global X Robotics and Artificial Intelligence ETF. I'll be honest, I was skeptical at first. Some of these ETFs have a bad reputation for selling you the future at yesterday's prices, but the numbers here tell a different story. Over the past 3 years, BOTZ has returned about 21% annualized. It's roughly matching or beating the S&P 500 over the same period. Where I got a bit concerned was when I looked at the 5-year. It looks ugly at just over 2% annualized. But I believe that's because BOTZ got crushed in the 2022 growth stock sell-off when rising rates punished anything with high multiples. So what are you actually buying? BOTZ holds 50 companies across the robotics and AI ecosystem. NVIDIA, Japanese industrial automation giants, surgical robots leader Intuitive Surgical, and precision automation companies. Sector-wise, it's roughly a split between industrials and tech, with some healthcare exposure layered in. Geographically, you get meaningful Japan exposure, which matters because Japan is one of the global leaders in industrial robotics. The global robotics market was valued at just under $100 billion in 2024. Forecasts suggest it could nearly quadruple over the next decade, with labor shortages, aging populations, reshoring, manufacturing, and collapsing AI compute costs are real tailwinds. Now, this isn't speculative. Factories are buying robots, hospitals are buying surgical systems, warehouses are automating. And what I like about BOTZ specifically is that it's not new. It's been around since 2016. It has scale, liquidity, and a defined methodology. The expense ratio isn't cheap, but you're paying for curated exposure instead of guessing individual winners in this race to robotics. The fund also rebalances annually, which matters. NVIDIA might be around 11% today, but it gets trimmed back. No single company is allowed to completely dominate the portfolio. There are risks, and they are real. The top 10 holdings make up more than half the fund. If NVIDIA stumbles or Japanese industrials underperform, you'll feel it. Valuations are not cheap, and with a beta higher than the S&P 500, this will be more volatile in market sell-offs. But that's the trade-off. BOT gives you exposure to robotics and AI as a system, not a gamble on single futuristic stories. The bottom line, after looking at individual names and the hype around humanoids, BOTZ is one ETF I'm looking at to get broad robotics exposure. Cash doesn't chase hype. Cash flows into systems that quietly scale, and that's how cash works. If you enjoy these breakdowns, please help me out by clicking the subscribe button or the like button. It helps the algorithm a lot, and I'll see you soon.